Good afternoon and welcome to our second in series of spring seminars. Those of you who joined us on Tuesday would have heard the arable focus seminar, and today we're going to focus on the livestock sector. We're going to cover items such as Brexit, those that remember that, and of course the transition period. And the way we're going to do this is by showing and sharing with you a series of short videos. You will then get the opportunity to forward questions to our panel of experts. At this stage, I just want to mention none of our experts are land agents, so we won't be able to give you the definitive answer on land prices and rents. However, like land agents, I'm sure we'll be able to give you an opinion. So, just a few housekeeping rules. All of your cameras and microphones have been disabled, which is perhaps a good thing. However, at the bottom of your screen, if you move your cursor, you will see a series of tabs, and one says Q&A. If you select that, you can then type a question, which we will be able to see, and I will field those questions to the panel at the appropriate time. I'll remind you during the course of the seminar to keep those questions coming in. So without any further ado, we're going to proceed with the first videos, which cover sheep and beef and the dairy sector. So first video, please.
Hello there, my name's Simon Wearmouth from Brown&Co. I'm a partner here in the Norwich Agricultural Business Consultancy team, and I've been asked to speak to you today regarding the beef and lamb sectors. The current situation with the market, where we might be medium term, and some other external factors which are going to be affecting some business decisions over the next few years. So first of all, looking at the beef markets, as you can see, and I'm sure you're all aware, beef prices are on an all-time high at the moment. Deadweight prices are still climbing, and supply is anticipated to tighten even further. We're undoubtedly benefiting from the COVID effect at the moment, with more people cooking at home, and I think that the benefit from that just needs to be tempered slightly on the basis that when lockdown begins to ease, then it's pretty inevitable that when the restaurant trade begins to open up, they'll be looking to fill some of that supply via the potentially cheaper foreign imports. So we just need to bear that in mind. And also when thinking about the slightly more medium-term effect, the fact that quite a number of breeding cows have probably found their way into the food chain due to high prices, combined with the new directives coming from some of the assurance schemes and dairies about black and white bull calves being brought into production systems rather than euthanized at birth. That's going to have a knock-on effect on supply going forward, and we just need to wait to see how that is actually realised. Just moving on to lamb, similar effect being seen in the lamb markets at the moment. Price again really high demand for home cooking again. This has lasted all year with strong demand going forward, probably bringing more lambs forward earlier in the season than would have happened normally, so that they could realise some of those high prices, which has left numbers short at this time of year. So prices are anticipated to carry on probably until we see a good influx of new season lamb coming into the market, and even then there's no sign or reason for that to drop at the moment. But again, lamb producers need to be aware that the effect of easing of lockdown and the restaurant trades looking to fill some of that demand as they begin to open up and begin to trade from cheaper foreign imports again will undoubtedly be the case. There's reports from some good scannings left, right and centre at the moment. So ewe condition wasn't seen to be compromised at tupping, and I think probably eyes will be all on the weather for the next couple of months to see what the net effect is going to be on the 2021 lamb crop. Just moving forward in terms of thinking about Brexit, not in the news quite so much as it was last year, thank goodness. But I think just need to think about the net implications of what's been agreed. The market did slow in December slightly pending an announcement of a deal or no deal, and thankfully after all that political posturing, a tariff and quota-free deal was announced, allowing the market to rally again. And whilst tariffs are not a concern at the moment, trade friction certainly is. So we've all heard all of the reports about exporters suffering significant delays at borders because of incorrect paperwork, etc. And whilst this is an issue for all exporters, it's even more of an issue for exporters of perishable goods. So that's just something to bear in mind, because all that additional paperwork, physical checks, labelling, etc., will all add cost. And it's anticipated that that will find its way back to the primary producer. Just moving on to the agricultural transition. So with the passing of the Agricultural Act, we've got a roadmap for the transition of UK ag. BPS to decline to zero between now and 2027. Whilst initial simplification of the rules with the relaxation of three-crop rule and various greening measures is welcome, I think we just need to bear in mind that whilst those BPS monies are going to be reinvested into the various capital grant schemes and the new ELM scheme, that won't commence until 2024. So there is that concern over a funding gap. The focus of ELMS, once it arrives, will be the delivery of public goods. And I think of key interest to the beef and lamb sectors should be that some of those focus areas are to include managing land to improve the environment, managing livestock to mitigate or adapt to climate change, protecting and improving animal health, and protecting and improving the quality of the soil, all of which affect and can be influenced by the beef and lamb sectors. Those capital schemes that are going to be available, which will be redirected funds from BPS, will be aimed at farm sustainability resilience. Full details to be announced as soon as this autumn. So the funding gap that I mentioned earlier and the concern about that between now and 2024, we were strongly recommending that should be addressed by entry into a countryside stewardship scheme. When ELMS is released, if it looks more attractive, businesses will be able to quit their current countryside stewardship scheme and enter into ELMS at that time. However, a well thought out stewardship scheme can work to the advantage of a business in terms of providing some additional income without causing too much difficulty to their current economic and efficient production. In addition, one extra element that can be of interest or might be of interest to some producers will be that the fact that there will be an announcement later this year regarding the delinking and capitalisation of BPS, which will provide a lump sum for those wishing to retire from the industry. Further details to be announced, but that kind of lump sum could be attractive to those wishing to retire and could be looked at in conjunction with some sort of joint venture, either with a neighbour or a new entrant. So watch this space for further detail on that front. Just looking forward, significant changes are coming. We've already been through that. And the comfort blanket of BPS being removed over the next 7 years is going to have a significant effect on how people need to run an efficient business. An alarming number of beef and sheep producers are or won't be in a profit-making position once that BPS is removed from their turnover. So in the medium term, businesses must act now to mitigate that impending loss. One way of doing so we've already outlined, would be by the entry into a new countryside stewardship scheme. There's some quite attractive options within there if you look at that in detail. And then looking longer term, I think producers need to be aware that with all the new trade deals being done across the globe, that will of course bring opportunity, but it would also bring competition to the marketplace from more foreign produced beef and lamb coming into the UK. However, I think on the basis that January is now over and the focus on not consuming too much meat is potentially out of the headlines as much as it was, the nutrient-dense, protein-rich produce produced by the UK beef and lamb sector is well placed to deliver part of a healthy and balanced diet, but that produce needs to be reinforced by a positive public image. Full advantage has got to be taken to recoup some of that lost BPS income in Elm's longer term, alongside the various capital grants that are going to be available and announced later this year. So businesses must plan accurately and control business finances in order to farm profitably, have maximum control of their business, and maximise production with firm cost control. Just in terms of the future prosperity of the industry, and I think if I was to give you some takeaway messages, I think change is now, for those wishing to continue into a profitable business, adaptation and adaptability is key. So in summary, I think cost awareness is crucial, and effective business management in this sector is no different from any other, and this is going to become more critical and a skill that all producers will need to focus on and develop. Changes to agricultural policy may not sit comfortably with everybody. However, there will be some elements of that new ag policy that will work well for your business if you're willing to be open-minded. And finally, opportunities are available to look at different ways to operate your business. A willingness to change and adapt when necessary is key. Thank you very much.
The UK dairy sector is a vital sector, producing high-quality products for the domestic and international markets. Any business will thrive when there is stability. The dairy sector is no different. Knowing what trading opportunities will be available to them post-Brexit will be critical, as well as understanding the transition of phasing out BPS and introducing a new approach. There's a lot of information out there suggesting that the dairy sector will not be badly affected by Brexit, given that the UK is not self-sufficient. We are producers of high-quality milk with robust traceability, and the welfare standards in the UK is amongst the highest in the world. It's certainly an interesting time for the industry. The two main dairies in the UK, being Arla and Muller, both multinational companies, could be a big positive for those already supplying these companies, as it's already a route into Europe. Of course, on the downside, border controls will be tighter, meaning possibly more and complex paperwork. Global consumption of dairy is growing, with demand for fresh and processed products forecast to increase over the next decade respectively. For some areas in Africa, Asia and the Middle East, consumption is growing at a faster pace than production, and this is where potential opportunities lie for the UK. The strong demand has certainly caused a surge in recent global dairy trade auctions. In fact, there have been 9 increases from the past 10 GDT auctions since 1st of September 2020, covering a 5-month period, which has seen all the products price and index rise by 21%. Cow prices also remain high. This shows that there's certainly confidence in the industry moving forwards, but purchasing cheap replacements from abroad could certainly prove to be a challenge. For many farming businesses, the BPS plays a significant role and will be sorely missed, considering the new approach should be a priority for all producers. Emissions could be one of the industry's greatest challenge moving forward. Dairy cows have been implicated as a huge contributor to UK greenhouse gas emissions, releasing large quantities of methane as a result of enteric fermentation in the rumen, and nitrous oxide during manure storage and management. Dairy farms are already sequestering carbon, but more can be done within the business, and further action needs to be taken to meet government's legislation, which legally commits the UK to a target of net zero for all greenhouse gas emissions by 2050. Furthermore, the NFU have set the goal of reaching net zero by 2040. The source of feed for the dairy cow, well, diets could change to exclude imported items such as soya. Optimising the storage and use of manure and slurry can reduce artificial fertiliser usage. Improving grassland management and grazing systems reduces the reliance on purchased feed. And another one is genetic selection for low emission cows. And of course, using renewables on farms, such as electric vehicles. For those who are committed to the industry long term, there will be much to think about, as well as opportunities available. The key points and focus should be to concentrate on quality rather than quantity, and efficiency as opposed to output. Improving on-farm efficiencies will lead to improved profitability for the farm business. And it's critical that dairy farmers are aware of the environmental schemes that will reduce the diffused pollution and capitalise on some of the capital items available, such as rainwater harvesting, which will improve their financial performance and offset the reduction of the basic payment scheme.
Thank you, Simon and Non. That was really interesting. I suppose the first thing, Simon's talk, that graph showing lamb prices. I don't think I've ever seen a graph like that in the last sort of 25 years with such positive prices, but quite rightly, Simon, it comes with a warning. And how interesting, COVID, I suppose a disruptor, totally, how it's changed the eating habits of people. I can't help feeling the mood has changed in the country, and there's an open door for us as an industry to push against, albeit, yes, the risk of foreign imports without a shadow of doubt. Then, Simon, you sort of touched on potential availability of grants to help with climate change, animal health, and soil health. So something for us to be aware of and keep an eye open for, as well as countryside stewardship. Potential opportunities for those that maybe want to exit the industry, the lump sum. And I think the way you summarized it as well, cost awareness, opportunity, and be open-minded. Very important. Then crikey, one of the perhaps most sort of positive industries at the moment, dairy. I didn't realize the extent of lack of sort of self-sufficiency we have and importation of dairy products when you think we are one of the potentially best milk producing countries in the world. We have got those established multinationals, which has to help us get access to foreign markets. And what a positive that global consumption is growing faster than production. And within that, surely there's got to be customers who want quality. And again, you mentioned that, quality, not quantity. The challenge, loss of BPS, but also emissions, constantly sort of out there in the media. So somehow we need to deal with that. And perhaps genetic selection or access to grants is going to be a way to do that. And again, if I could say, your final term, efficiency as opposed to output. I think that's an excellent sort of point to end with that. So thank you again, Simon and Non. We're now going to move on to the next set of videos where Will is going to talk about the poultry industry, and Lottie, one of our environmentalists, is going to give us an update on the environmental schemes and specifically the livestock sector. Can I remind you to keep those questions coming? We've had a few, but we've got space for a few more, so please keep them coming. So could we have the next videos, please?
Hi all, my name is Will Scott from the Brown&Co Norwich office, and today I'm going to give a brief overview of the UK poultry industry. Today's topics include an overview of the industry, looking at the meat and egg sectors, looking at the potential impact of Brexit, looking forward and the opportunity in the industry, and then going to provide 3 take-home messages. Firstly, looking at an overview of the industry and focusing initially on the meat sector. The UK industry produces around 1.93 million tonnes of poultry meat per annum, through placing between 20 to 22 million birds on farm every week. There are a number of poultry integrators in the UK, however the main ones include Hook 2 Sisters, Moy Park, Avara, Cranswick and Bannon Poultry. Total consumption in the UK is estimated at 2.5 million tonnes, of which 1.93 million tonnes are produced here in the UK, with the remainder imported from the EU, as well as Thailand and Brazil for processed meats. This means that the UK is around 76% self-sufficient in poultry meat production. The UK has seen significant growth in the industry, and over the past 15 years, this is estimated at 25%, with poultry meat, and more specifically chicken, being the UK's most popular meat, with 91% of consumers eating poultry meat at least once per week, and on average eating 36 kilos per capita per year. Now looking at the egg side of the industry, approximately 12 billion eggs are produced each year from a flock of around 42 million birds. And of those 42 million birds, it's now estimated that 56% are free range. The UK consumption is around 13 billion eggs per year, giving a self-sufficiency percentage of 89%. Egg consumption per capita has grown from 171 eggs in 2004 and 197 in 2019, with overall UK egg consumption growing by around 260 million eggs per year since 2006. Now moving on to look at the potential impact of Brexit in the industry. There are a number of impacts that Brexit could have on the poultry industry. However, since the trade deal has been done with the EU, some of the more concerning impacts have been reduced. The three main impacts I'm going to just focus on quickly is number one, trade policies and trade deals. The EU is the UK's largest trading partner for both meat and eggs. Logistical issues with fresh and frozen meat, additional compliance and paperwork could cause disruption to the supply chain. The UK must, however, consider the impact on the industry of any trade deal done with a non-EU country who have different welfare and production standards to the UK, for instance, the USA. Secondly, looking at labour availability, EU labour accounts for a high percentage of jobs within the industry, especially in the processing supply. It's essential that this supply continues. And then thirdly, regulation and compliance. The UK must maintain its high welfare and regulation standards, and the government must do more to protect this and not allow cheap meat to come into the country unregulated and undercut the market. Looking forward and the opportunity in the industry, despite the threats to the industry, there's a huge amount of potential and opportunity also. Firstly, rising demand on an annual basis, both in the meat and egg sector, with the UK currently not being 100% self-sufficient. Secondly, the chance for investment in the industry as the UK's older housing is replaced, with the chance to improve both performance and welfare standards on farm. This is not without its challenges, however, mainly planning, and in some cases returns are under pressure. As well as this, the UK is a leader in welfare standards and efficiency, and there's an opportunity to promote this further. Finally, there are numerous investment opportunities in the industry, and it's an industry that is not heavily reliant on government subsidies. Finally, three take-home messages. And for the UK poultry industry, I take these as, number one, it's an industry with consistent growth, both in supply and demand, and one which promotes investment. Secondly, it's an industry that's efficient, performance and data driven. And finally, an industry that is non-reliant on the UK's main government support mechanism of BPS, which, as we know, is reducing over the next 7 years. Thank you very much for listening.
Hi, my name is Lottie Hill. I'm one of the environmental consultants based out of the Norwich office in the ABC division. I'm going to be giving a quick environmental update for you this afternoon, particularly focusing on the livestock industry. Public money for public goods is a phrase that you'd have heard bandied around quite a lot. What this actually means is for some of the environmental services on farm, you can receive funding. At the moment, this is mainly in the form of countryside stewardship schemes, such as wildlife offers, mid-tier and higher tier schemes, CSS capital grants, and for woodland, there's woodland creation and woodland maintenance schemes. This year, the countryside stewardship application window opened on February the 9th. There are some changes this year, including the new CSS capital grant scheme, which replaces the water capital grant and the hedgerows and boundaries and combines it into one. Funding of up to £60,000 can be paid for three categories: boundaries, trees and orchards, water quality and air quality. The important thing this year is you can apply for these if you're already in a HLS scheme. School visits, which were previously a higher tier option, are now down to mid-tier, and they pay £290 per visit. And air quality options, which are going to be particularly interesting for those in the livestock industry, have been included. These are automatic slurry scrapers paying £2,760 per passageway and a low ammonia emission flooring. There's also a chance to plant trees and create shelter belts, which is particularly good for those in the pigs and poultry industry. Some of the headline dates that I want to make you aware of this year are as following. The CSS Capital Grant Scheme has an early deadline of the 30th of April, with any options that need catchment sensitive farming officer approval must be requested by the 19th of March. The Higher Tier Stewardship Scheme also has an early deadline of the 30th of April. Application packs must be requested by the 31st of March and catchment sensitive farming officer sought 6 weeks before the deadline. Mid-tier and wildlife offers have the final deadline of the 30th of July. Application packs must be requested via the phone by the 28th of May or online by the 30th of June. Catchment sensitive farming officer approval has to be sought by the 18th of June. Any options that need RPA permission have to be sought by the 30th of May. I know there are quite a lot of dates there, but it's good to get the main ones that you need in your head now so you can plan appropriately. Capital items provide a real opportunity to invest in the farm that you've got, with good grants covering about 70% of the cost. Some of the ones that are most interesting to our clients are hedgerow planting, which pays £11.60 a metre, livestock tracks, which pay £33 a metre, livestock troughs and associated piping, which pay £110 grant and £2.65 a metre, and stock fencing, paying £4.90 a metre. Another popular capital grant is concrete yard renewal, which pays £27.14 a square metre. Here are some examples of previous grants that we've applied for and some before and afters. There are some changes afoot, especially due to the impact of Brexit and the agricultural transition period. What this means for us is that schemes starting from 2021 onwards are now under UK legislation. CSS inspections will be more focused on environmental aims, and no penalties will be applied on top of recoveries. What I mean by this is previously, if you were short of an area for an option, you would have to pay back what you've overclaimed, and on top of that, a penalty will be applied. This penalty now, no penalty will be applied on top, hopefully making inspections slightly less of a financial ordeal. The last date for CSS applications will be in the summer of 2023, with agreements starting in 2024. 1 year extensions will also be offered to mid-tier schemes and higher tier schemes, as well as HLS expiries. The idea that this will continue until ELMS is up and running in 2024. ELMS stands for the Environmental Land Management Scheme. Pilots are starting in 2021 with at least 5,500 participants. The scheme should be up and running in autumn 2024, and anyone in a CSS scheme can leave their countryside stewardship to join ELMS with no penalty. Landowners are likely to be required to create a land management plan which will identify the ways that the farm can meet objectives of the Environmental and Agricultural Bill. At the moment, there are 3 tiers or schemes that are available. The first is the Sustainable Farming Incentive, which is looking at sustainable practice within the farm for forestry and farms. The Local Nature Recovery, which is focusing on local priority habitats and species as stipulated by a local nature recovery strategy, likely by a county-based, and Landscape Recovery, which is focusing on large-scale habitat creation, restoration, such as rewilding projects. There are 3 kind of take-home messages that I want you to have today. First is to prepare for the future, work out your BPS reduction and how countryside stewardship can fit within that. Utilise the capital grants that are available and make your farm fit for the future, and engage early this year. As I said, catchment sensitive farming officer approval needs to be sought 6 weeks before the application deadline, so it's really important if there are things that you want on farm to get in contact today so we can sort out the permissions that are needed. Thank you for listening.
William and Lottie, thank you very much for those videos. Again, some astounding figures in the poultry. I'm not even going to try to remember the tons, but sort of what struck me, 91% of the population eats chicken at least once a week. We are 76% self-sufficient in the meat production and 89% in egg production, and demand is growing. So that's got to mean there's an opportunity. There's challenges, of course, trade, welfare, imports, and of course, labor. But a market where there's consistent growth, something where there's efficiency and that's data driven, and also not reliant on BPS, but more of that later. Then on the environmental, the main points, that term public money for public good. And I think the salient one is that a lot of people believe that stewardship is only something that's of value or suitable to arable businesses. Well, that isn't true. And if you look at some of those categories for capital grants where you can get up to 60,000, to do with boundaries and trees, water quality, air quality, it's got to be something worth looking at, to improve your infrastructure on the farm. An awful lot of deadlines. I can't remember any of them. So you might need to follow that up. And then, of course, the opportunity of ELMS in 2024. But remember, BPS is going to reduce between now and 2024. Just a heads up to everyone for the month of March. So from next week, Thursday, every Thursday in March, our environmental team are going to be online, available for a drop-in session. So keep an eye on your social media feeds for advertising. There's going to be a lunchtime session and an early evening session every Thursday where you can log in and ask any questions about that. So keep an eye out. Just a reminder to keep those questions coming. We've had several, but we've got time for a few more. The next video is going to be by Greg, who deals a lot with carbon as well as other environmental matters. And we're hoping Greg can help demystify the world of carbon and give us some indication of fact from fiction and where the future is heading with that, and perhaps what opportunities there are for us, both landowners with perhaps the opportunity for forestry, but also those of us who don't have that. So could we have the next video, please?
Carbon has emerged in the past 18 months as a talking point and opportunity for many farmers. There are a number of areas within carbon. So firstly, if we think about emissions, and these are really captured by the range of footprinting tools that are available for farmers to use. These aim to try and capture emissions from fossil fuel usage, so diesel, from tillage techniques, from fertilizer usage, or from livestock. And the idea here is to understand where the current baseline is so that plans can be put in place to reduce those emissions going forward. They tend not to be so strong on capturing and understanding the sequestration on farms. So this is how new carbon can be captured and sequestered either in soil or in woodland. So let's look at those two areas now, and that's really looking at woodland and soils as a means for landowners to capture carbon. So woodland has emerged and is running with some pace, I have to say, and we're working with many tens of landowners in this area. These landowners tend to be those who are looking to establish either small areas of woodland for operational ease, or it might be to improve amenity, shoot, or tourism on a farm. Or we have others who are we're bringing into some larger projects we've got where woodland can actually displace root crops on farm because the income potential is very high. In both cases, there's a process that involves working with the Woodland Carbon Code, which is a framework that sets out how woodland should be planted, how it should be managed, and produces a calculation of how many tons of carbon that woodland will capture. There's a carbon guarantee, which is a government auction that allows a guaranteed base price, to be secured for carbon captured, and then there are grant mechanisms that allow for the cost of trees, establishment, and the protection to be paid for. So there's a suite of different administrative and grant processes that come together, which all help to support landowners in establishing new woodland. They generally take about 12 months. So from the starting of process, it's usually 12 months before any tree is put in the ground. They are quite cumbersome from an administrative perspective, but we have a very strong track record and success rate in working with these, and actually have been the largest project developer working with the Forestry Commission over the last 12 months. So alongside woodland, there is the emerging soil carbon market. It's more complex because soil carbon is harder to measure, it's easier to lose carbon from soils, and there isn't an agreed standard that everybody's working to as there is with the woodland carbon. But it is changing, and we do expect in the next 12 months there to be some schemes available and landowners signing up to those that will allow this new market to start to develop. We are looking to work with landowners on this right now, and we're looking to understand how income from soil carbon can be part of a portfolio of income on farm. The income from soil carbon is not going to be as high, we don't think, as it will be from woodland carbon, but there is a potential for gaining over a much wider area. So it's an exciting and interesting space where I think in the next 12 months, as I say, we will see some movement. So across these carbon areas, we have a considerable amount of experience and a really strong track record working with landowners and working with those bodies such as the Forestry Commission who have been driving these initiatives forward. We see it as part of a whole farm approach that aims to assess and identify which land areas are most appropriate for which land use. This, I think, is going to result in land use change for some, but it allows new income streams to be built that weren't around a number of years ago. And we see that as preparing farms for the future and building resilience. So please do come and talk to us. We're very happy to have an initial conversation to work through some of the vagaries and complexities of these schemes, and do hope that we can help as many landowners as we can in these exciting new areas as we move forward. Thank you.
Greg, thank you for that. I think it's helped sort of clarify a few things. So we've got the emissions issue, and then we've got sequestration, and please no jibes about my accent, so thank you, which is divided into woodland and then soil. And Greg is on the panel, so we've had a couple of questions directed already for you, Greg, so please get ready. How about sort of this carbon guarantee scheme and sort of different crops involved with it, and then what's coming on the soil front and how we sort of use that. But definitely a potential source of income at last. Before we go to the panel and start taking these questions, I thought it might just be useful to spend a few seconds on looking at some model budgets. So a few years ago, we decided to set up some model farms reflecting different industries within agriculture. So we did an arable farm, and we've also done a sheep and cattle farm, and then as well as a dairy farm. And the reason for doing this is we wanted to try and run different scenarios through these models to see what the financial effect will be. And naturally, the big one at the moment is the sort of BPS and the reduction thereof. So we're just going to have a quick look at headline figures before we move on to the panel. So here we have our sort of a sheep and suckler cow farm. So this is a projected budget for next year, the 2021 sort of harvest period going through to April 2022. So there's just two figures I want you to have a look at. The first one in sort of the top third of the page where it says add other operating income, we've got miscellaneous of 9270. Well, within that, this business has a bed and breakfast. But underneath that, basic payment scheme, 32,694. And then the bottom figure on your screens, profit and loss for the year before drawings, 16,860. Next slide, please. This slide shows you the potential effect on profitability during the transition period with all other factors except the reduction of BPS staying the same. So you can see through the middle of your screen, estimated receipt, as far as the BPS goes, 31,230 in 2021. So that's with the first reduction. Then to 26, then to 21,000, 2024, 16,000. So we're looking at about 50% then. But do look at the bottom line, the profit or loss. We go from 16,860 to 11,900. 2024, small profit of 1,995. And then 2025, we slip into a loss-making situation. So this reflects the importance of BPS to the sector. Next slide, please. So this is 160 cow sort of dairy farm. And again, we'll just look at those headline figures. Next slide, please. So middle of the page, basic payment scheme, 17,932. And then sort of at the bottom, for some reason sort of can't see it, but we'll pick it up on the next slide. Next slide, please. Profit of 49,972. So we're looking at the 2021 column again, showing what happens during the period from 2021 through to 2028. So you can see how the BPS reduces from 2021 of 17,725 going down, and then you can see what happens to the profit level from 49,972 down to 32,247. So the dairy model farm is probably the least worst affected of all the industries that we've had a look at. However, one could sort of say, is that a fair, that profit that we end up with, sort of 2028, is that a fair reflection on the investment and work of the proprietor? And what are the other variables that could sort of come into play with that? So I think it's fair to say all businesses are exposed to a greater or lesser degree as far as the reduction of BPS in the transition period. Okay, so I'm now going to ask the panel to get ready. I'm just going to introduce them. We've got Charles Whittaker, who's our managing partner, Rob Hughes, a partner from our Kingsland office, but also a dairy specialist, Phil Dunn, partner from our Brigg office in North Lincolnshire, and I think I've covered everyone. Or Greg Beaton, you saw about the sort of the carbon. So we've had a number of questions, so we may not have time to deal with all of them, but we're going to try. Those that we can't, we'll answer afterwards directly. So first question that I've got is. Yellow. Okay, so I'm going to send this one to you, Greg, if I may, because it's to do with stewardship. Somebody has said, I'm already in various stewardship schemes, so how will I be able to compensate or get compensation from the loss of BPS for somebody who's already in a scheme?
Thanks, Paul. So I think the answer to that, and that we've seen that a few times with people who've been early adopters of stewardship and been running with it for a few years. So I would say the first thing to do would be to have a look at what the new opportunities of new schemes offer. There are new options coming along. There might be options to go into higher tier if you've got any particular features there of interest to Natural England or similar. I think as we move towards elms, and Lottie talked about different tiers of elms going forward, I think particularly when you look at the option 2 and option 3, which are more around landscape and local biodiversity networks, there'll be options there to increase the size of what you're doing already. But the other part of it, I think, is to have a good look at what's happening on the rest of the farm. And we're seeing now a real focus on the productivity, net output of the rest of the farm, and really trying to understand whether there are options actually to take land out of what you're doing already and putting it into other environmental schemes, where some of the returns now are actually stacking up very well against more variable net margins on other crops. So I think the summary would be, have a real good look at what you're doing. There are always developing options going forward and new things coming up. Now, the last thing I'll say is on carbon, is that as we move forward, I think there will be opportunity to take some carbon incomes. Those are not going to be necessarily huge incomes, but they will be additive. So building a bit of a portfolio up of income, of new income streams as they go forward, I think is the way forward.
Thank you, Greg.
Paul, can I just add, I think it's a really useful question, because I think there's a miscomprehension generally out there that ELMS is going to come on top of whatever else you might have already, and it isn't. If you're not in stewardship, ELMS becomes a potential mitigator of a BPS reduction. But if you've already got a comprehensive stewardship arrangement, then ELMS is going to be no form of rescue. So not trying to pour cold water on anybody, but we just need to be clear as an industry that it's not a straightforward way to mitigate the net reduction of that BPS cut.
Yeah. Okay. Thank you.
Just raise a point on that, Paul, as well. I just want to raise a supplementary point on that, if I could. I mean, Greg alluded to carbon possibly being an income source. And I think we've had quite a lot of debate over the last 12 months and got a few sort of pilot projects going and some analytical work underway that's suggesting, Greg, stop me where I'm wrong, but suggesting circa maybe 3 tonnes a hectare of carbon under some normal condition agricultural land use, maybe, and a market that is emerging and has emerged indeed under the Woodland Carbon Guarantee Scheme already, which might be somewhere, Greg, between 18 and 25 pounds a tonne for carbon, possibly something of that nature. So in terms of looking for this extra income stream, yes, there is probably going to be some that will emerge, but it's some time away. And I'll echo Rob's point, really, that I don't think ELMS is a sort of a great sort of panacea rescue. I think if we're sort of throwing numbers around, we might, I think all of us will probably agree on this panel, maybe we might end up with 35–40% of BPS payments on a sort of generic all acres basis, possibly. I mean, that's a gut feel as to where we might be heading, but I think the message there is it's going to be less. And so if our basic production economics don't work for whatever reason, soils, location, nature of farm, ability to achieve results, whatever it might be, that's what we need to address, really, because as Rob just said, ELMS is not going to be the rescue.
Yeah. Greg, there's another question while we're on this theme, so we go slightly out of order. Someone's asked, Greg, please explain the carbon guarantee and what it means potentially in pounds per acre. So could you just give us a bit more of an explanation about the carbon guarantee scheme and what it could mean practically on the farm as a return per acre?
So this is the Woodland carbon guarantee scheme. That's the government scheme. They've basically, at the moment, put £50 million in a pot that they're launching through a series of auctions. And that so far has yielded anywhere between 18 and 30 pounds per tonne of carbon. If you take trees sequestering around about 10 tonnes of carbon per hectare per year, you're up to somewhere around between 200 and 300 pounds a hectare. So 70, 80, 90 pounds an acre for the carbon monies. They are future income flows, and you won't get to that level until probably year 10, but that will be the average over the 35 years. I would say as well, with all the carbon talk at the moment, the expectation is the price is going to increase. So the market will develop and carbon will become more valuable. So the carbon guarantee puts a base in. It's a base below which your price cannot go any lower. So it's a really good way of thinking about planning going forward when there's only an upside, not a downside.
So Greg, if when we get there, the price is higher than what's guaranteed, you as a farmer can sell that to someone else in the market, if there's a market.
Absolutely, yeah. You can sell outside of the guarantee, and the government will have done their sums, assuming that a certain percentage of people will do that. Yeah. And I think the opportunity for every individual farmer also is to try and find their own market. I think the really interesting thing with some of the carbon initiatives going forward is that you might be able to develop a local market with your local business. And then it's up to you with that particular business agreeing how much they're prepared to pay for your carbon that you are sequestering.
Paul, could I just add a point there? Of course, what Greg also alluded to is the capture of carbon on the soil and the assessments that are at the moment a little difficult, but will become more clearer to make sure farmers do their own business assessment before they get too carried away with selling sequestration to others. But that's a process we're going to have to go through. It's a new thing that's going to become upon agriculture.
Yeah. Okay. Thank you. So next question, Charles, you can sort of kick off, but I think it might be one that's asking for a few views. So as a tenant of the National Trust in my 70s, mixed farming, 500 acres, what is the idea of going, or what do you think of the idea of going all grass, as they like it, reviews of landscape, etc., or retire with an ELMS package? I am in an HLS scheme finishing in 2023. So sort of rewilding or wilding sort of question. Charles, do you want to kick off with that, and then perhaps someone else might like to give a different view?
It's so difficult, isn't it? And also dangerous offering views on sort of scant information. But you talk about people's livelihoods, houses they live in, farms they've farmed for many years. But I think, I find it hard to answer that question specifically, really, because we don't know the specifics. What's the rent that's been paid? What's the existing profit and loss account? Are they farming arable land now? Is it all grassland? But I think in general, if we're thinking about some landlords like the National Trust who may have landscape interest and other heritage interest in the existing farming landscape or landscape in general, I think we're going to have to have a complete rethink of how that landlord-tenant relationship works, what the rent is that's being paid, on the basis that expect support to fall significantly, and I think we would expect rents to fall with that support, but probably not at the right stages. And we're going to have to do other things to generate income. If we want to have a worthwhile business and livelihood as a tenant on those holdings in the future. And I think if you're already at the end of one's working life, age 70, have we got succession? Can we line that up? Does it provide housing for members of the family and next generation? If it doesn't, and we haven't got succession, I think we should be looking pretty carefully over the next year or so at this retirement incentive that we think is going to come as one of the options from DEFRA, and how that deal might be struck with a landlord that might want to do something different with the holding, which really isn't about tenants making money from farming it in traditional ways that we might have been used to over recent years.
Thank you. Anyone else with a view? Rob?
The only thing I'd add is just have a jolly good look at your tenancy agreement. But I think it is all about succession, and it's about integration of approach with landlord, isn't it? Because the feudal days of punching up landlord and tenant largely are behind us, aren't they? And if we're going to go forward together, then there's got to be a way through that mire, hasn't there? Really, one would expect. So working together in collaboration somehow, if your own farming career feels like it's coming towards an end, either in terms of rewilding type approach or giving opportunities for others through joint venture, there's loads of opportunities, aren't there, for the retiring generation. But it's also true to say, I think, that from what we understand from government policy, they want to be much more active, they being the government, much more active in encouraging the elder generation to retire from the industry. And eventually, we know that policy does determine behaviour. So we can expect, I think, progressively over the next few years, maybe not just in 2022 when they're talking about the capitalisation of a couple of years of basic payment scheme, which we were looking at earlier today. It doesn't look terribly exciting if we're all honest about it. But there may be other things that come along that are quite considerably more encouraging for people to exit at the tail end of their farming careers. So, you know, I would not be encouraged to knee jerk just because we're in a period of change. Take a deep breath, really, and sort out what you want to do, because if the fun's gone out of it, it's a jolly good reason to change.
Yes, it's true.
Could I add a bit there, Paul?
Go, Phil.
Obviously, taking out the age and taking out the tenancy side of things, I think it's a good time then just to look at the real productive capacity of the holding. I think these changes into environmental type subsidies away from area-based subsidies will be a bit polarizing in the industry. So less productive soils could go off more into environment, and some who have highly productive soils will battle it out and try and make the economics add up. So I think we'll see quite a move into different land types, the different production systems. Somebody's got to produce the food.
Yeah, agreed. Phil, don't switch off. I think the next one's coming to you. It's quite interesting because there's a theme. We had a very similar one on Tuesday. It's about sort of banks and borrowing. So I'm a livestock farmer and I'd like to temporarily increase my overdraft. The bank is asking for a detailed budget and cash flow. They've never asked for one before. Why should that be the case, as I have a lot of value in livestock on the farm?
Okay, so to sitting on the fence here between the farmer and the banker, delicate position, but the bank is quite rightly not just viewing the issue of security, but during the looking to the issues of serviceability and any future debt. A business should always have a plan, should have a budget, should have a cash flow as part of their financial management, and be able to demonstrate they can comfortably service that debt. And the banks will now much more rigorously test that servicing through their debt servicing costs against the earnings from the operational activities. And they'll sometimes look at that and stress test it and make sure there is sufficient cover in funding that additional debt before they'll permit that to happen. So yeah, not just security. You might have a lot of security, but you might have a very unprofitable business, which will be a cash drain. And cash is the most important thing, obviously. Without that, you don't have a business.
Okay.
Is that sufficient?
Thank you. Okay. Rob, this one's coming to you. The dairy industry is buoyant at the moment, but what about all those negative forces at work, such as veganism? How should we best combat it?
Politics isn't really my thing. I'm not very good at being politically correct.
Have a go.
But I think I think there are some big discussions for the big organisations to deal with, and either deal with them or not. We, as a family, we talk about it, or I talk about it at the dinner table with I've got a 23-year-old and a 25-year-old. And I ask them what their view of life and veganism is, and they look at me like I've gone out. It's just a non-issue as far as they're concerned. So I think there's a media hype, and I think we get involved in a bit of a hollow drum about veganism, in that it's a fraction of 1% of the population, and even if it doubles every year, it's still a fraction of 1% of the population. And we've got to deal with it, haven't we? And it's not going to go away necessarily. And is it a threat? I'm not sure it is really. But it's just something that you deal with in business and you deal with in life. I think there are bigger threats to beef and sheep production, milk production in the UK that we can control, that are way outside the auspices of the hypotheticals of the occasional militant vegan. I know they can be pretty unpleasant in social media and that kind of thing. I don't know how we deal with that. But I think, you know, I think the globalization of food and the globalization of awareness bring all sorts of challenges with them that are going, you know, that are new challenges, aren't they? That we've got to get our heads around and deal with. Veganism is perhaps one of them, but I suspect, really, in the overall picture of things, it's one of the smaller items of contention that most businesses are going to deal with on a day-to-day basis.
Okay. Next question, Charles. It's to do with poultry. What are the main risks and rewards of setting up a poultry unit? So there's a very open one.
Gosh, yeah, better start and finish. I think, well, as you know, we've been quite, as Will said there, quite heavily involved in the rural industry, particularly over the last 10 years, I suppose, in encouraging investment to gearing up on arable land to borrow money at low rates to build assets and build income streams. That's, we've looked at it very much as a business. But I suppose the risks that come and go have obviously had market disruption pretty severely in the early days of COVID, in terms of the integrator industry sorting out what supply chain it was providing to. The likes of Nando's supply chains were sort of stopped overnight, but then, you know, over a couple of months it swung into action through delivering more through supermarkets. So it's a very integrated, sophisticated business and quite a sophisticated supply chain. And so we didn't face some of the disruptions that others have done, but that's a risk. Planning risk, you know, we're a check for probably 100 grand if you're going to be pursuing a serious unit on a farm, and subject to how carefully you do the scoping application, everything else, and that's obviously a risk until it's there, and it's relatively big numbers. But I think as a production platform, it's pretty stable really, because it's sophisticated, it's multiple crops a year, it's a high level of technology involved and data, I think, as well alluded to on his presentation. There's been disease risk. Obviously this year we've had avian influenza to contend with in various areas of the country, and that's a threat. Salmonella's a threat, but it's a sophisticated industry that's got various ways of managing those, and insurance being the obvious answer. But yeah, so I think and rewards are good. I mean, 10 to 12% returns, subject to how you're doing it, who you're doing it with, how expensive your build is. And so it's been a great addition to the farms that we've been involved with, where we managed to introduce it at all sorts of scales, really. And I think, as Will said on his presentation there, there's increasing demand despite, as Rob's alluded to, pressure from non-meat eaters, etc. It's a cheap, readily affordable protein that the consumer wants, and uses a lot of wheat.
Charles, is there a geographical sort of element to it, with processing and all the rest of it? As in,
processing capacity, yes, in terms of maybe 40 miles to possibly 70 or 80 miles as a max distance, maybe, but through the Midlands, across into East Anglia, across into sort of some part of the northwest. Yeah, there's processing capacity scattered about near to centres of population, for very obvious reasons. So it's reasonably benign as far as specific locations are concerned. Planning is the biggest driver, is the location, access, HGV access, highways, visual impact, ammonia levels, etc.
Yeah. Okay.
Could add to that, Paul. I mean, Charles alluded to it being a sophisticated supply chain. It's one of those sectors where contracts are commonplace. I think a lot of agriculture's got to learn about that. We tend to still do a lot of free market trading, and I think that might be something that becomes less so in the future. Got to get closer to the next person in the chain and work with them. I know we've always said that, but I think there's a lot of sectors that haven't achieved that as yet.
That's a good point.
That's a good point. I mean, both the pig and poultry sector, isn't it? In terms of obviously seeing this enormous leap in commodity feed costs, commodity values over the last, well, since harvest really, and looks like staying with us for a while through to next year as well. And that's put a lot of pressure on production costs, obviously pigs and poultry. And generally the poultry industry has quite a good relationship between ex-farm chicken price and feed cost, because it is quite a sophisticated supply chain with pretty sophisticated contractual arrangements. And largely that's the case in the pig industry as well, but not exclusively. And there's been quite a lot of disruption in the last, well, since January really, as people are knowing the pig trade because of border friction and problems and issues that have altered the balance of carcass sales in the carcass sale in the UK, and that's caused a lot of difficulty along with very high feed prices. So yeah, so going about risk, so price volatility, I suppose, as far as feed costs, the biggest risk for both those sectors, because it's a major component of cost of production.
Yeah. Charles, while I've got you on, you mentioned pigs, and we didn't have anybody talking about pigs. So there is a question for somebody. I've been approached to do B&B for pigs. What are the main considerations?
Okay, was that one coming to me, Paul?
Go on, yeah, and I presume B&B is bed and breakfast for pigs, isn't it?
Yes, it is, yeah. There's a huge demand. Again, the specialisation in the industry has led to a requirement to take off a lot of those finishing units onto third parties. So the breeding being done in-house and the finishing going off to what is in effect B&B. So the farmer would, in those situations, normally, and there's a few different models, but normally provide the buildings, the labour and removal of the slurry. And then the pig company would provide the feedstock and the feed. Sorry, the stock and the feed. And it's a good relationship, and you can get all sorts of different ways of achieving that, whether it's pounds per place or per pig finished, weight gains. But a great opportunity for the arable sector because it's complementary. It's a good way of using up surplus labour. The slurry coming or the FYM coming out of the unit is going to be hugely advantageous in our new world of reduction in inorganic fertilizers, as referred to in one of the presentations. So yeah, it's a great opportunity, principally in pigs, but in other sectors as well.
Yeah, that's a good point actually. I mean, again, coming a bit further east on lighter soils where there's been an explosion in outdoor pigs, I would say, Norfolk, Suffolk, part of Lincolnshire as well, as you know, and a big demand for straw-based finishing accommodation. And as you say, great addition to arable units, great way of earning additional money, 8 to 10% returns available, really post labour costs. And so why wouldn't we be doing it really? And it produces organic manures, as you say, Phil, which will help us with soil organic matter, and which we might get paid for by Greg in the future as well. So it's a win-win.
And again, it's getting more and more sophisticated. Long gone are the days of the cowboys who drop you in it and run. These are good long-term supply arrangements from big players who are well financed.
Okay. And another question, and this may go to, well, any volunteers. It's about diversification. It's one we get quite often on farm. So what should I diversify into to make money? There we go. Who wants to go? Phil, come on, you're on the screen. Sorry.
Well, quite interestingly, a lot of the policy and the grant funding that we've discussed this afternoon seems to have completely missed those words diversification, tourism, etc. And there's a definite move away from that to help fund those new ventures. So it's sort of taken a slice out, actually, and a bit of the excitement out of it, because a lot of them have needed those fundings to get diversification activities going. But going back to the question, to me, it's all about looking at your assets. You diversify, A, from a position of strength, never if you're sat on the edge of a cliff about to fall off, very stupid place to diversify from, and B, recognizing your strengths and the assets you have. So don't hold a farm shop if you hate customers, and don't create a farm shop 100 miles away from a population. Don't look to create wind turbines in a valley. Again, it's just looking at the assets you have, and they're different for every business, from people, places, positioning, market, etc., to go through the plethora of diversifications and decide what's right for you. So there isn't a one-off answer. I'm sorry, Paul.
Yeah, and there isn't a golden bullet, is it?
think if I could just...
Yeah, and I'm just going to add, sorry, go on, Charles, if you want to go. I was just going to add that for those who are interested in grants or sitting, waiting, thinking, what's the next round of grants going to be on tourism and diversification, which we've been fairly well looked after as far as grants are concerned over the last 5 or 10 years. There's nothing in the current proposals as far as white paper is concerned, but the Chancellor's announcements yesterday, we think, are going to bring forward grant schemes for tourism and diversification, probably later in the autumn. So that, just because there's nothing currently in any paperwork, it doesn't mean to say it's gone away. It's just going to come from a different place. So that's point number one. Point number two, coming back to the question, do what you're good at, because we've seen over the years oodles of times where diversification has been the in thing to do, and then it wasn't, and then the diversification projects that were started 20 years ago that are still around are actually quite few and far between, in my opinion and experience. But the ones that are still around do really, really well, because the people who manage them do really, really well, and they're really, really good managers. So if you're going to do something that isn't core, make sure you understand it fully, and make sure you would enjoy doing it and you are committed to it, because otherwise it won't work.
That's really, really good advice, Rob. I think the only thing I would add to that, really, I mean, I think as Rob and Phil and I, all of us on this call have been around long enough to, as you say, seen diversification in the 90s. Perhaps that was pretty hard work, trying to add value to milk and make other products on farm, and it was all pretty difficult, and I would say not generally that successful. There have been some successes, of course there have. But I think what we have seen over the last 4, 5, 6 years, the ability of sort of the digital marketing footprint to access different markets, different products or different experiences much, much more easily when it was reliant on print media is staggering, really. And I think the other thing we've seen is the next generation coming into farm businesses and property businesses, with new skills, different ideas, different methods of working with people, interacting with people. And I think I would say we should have a very open mind about it. And I think we're bound to get grants that are going to help us get diversified enterprises running on farm business, whether that's tourism related or otherwise, because government know, and as you say, Rob, the budget alluded to a bit of that yesterday, government know that the farm production farm business has got a problem coming without 3.2 billion of BPS. And so they want to stimulate that new business startups. And I think where we've had lots, and also the other thing that's made it a lot easier is planning. And planning is still a nightmare, but it's a whole lot easier than it was a decade ago. And converting all sorts of different farm buildings from old sort of rickety old Trowbridge pig buildings that were already knackered 20 years ago to sort of low tin cart sheds to traditional brick and flint barns. I mean, there's just lots and lots of things that are being converted to all sorts of things, from studios to B&B accommodation to holiday accommodation or storage and commercial units, and develop lots of income streams. And again, the thing I would say is more difficult for tenants, where Rob's point about working with landlords, because they've got to worry about this too. Getting borrowing money on land and property, which is dirt cheap at the moment, at 3% for as long as you want almost, and to convert buildings into things that produce real revenue and real income streams to businesses. I mean, we should be doing it all day long and really working hard to make that happen, because the planning position is as open as we've ever known it. Certainly, it's not a walk in the park, I get that, but it's a lot better than it was a decade ago.
I just quickly add as well, just to pick up, I think just on the point around individuals, if you look what business angels invest in, they invest in people with a passion, and that's what drives most new business ventures and diversification. So as others have said, I think you've got to be in it and want to make it work. But the other thing I think as well, that we're probably coming into a period over the next few years, there's going to be a lot of learning from what has been a really tough time over the last 18 months in lockdown in the lives of the country. So I think there's going to be a lot more emphasis on enabling, health, well-being, different ways of doing things, and the great outdoors and the countryside, I think, is going to be integral to that. So I think there will be a window over the next couple of years for support for creating offices, ways of working, access, all those things on the back of what has been a tough time. And I think that's where there could be real opportunities to start thinking about getting into that, reasonably early.
Could I have a final point on that, Paul? I think it's about time as well, isn't it? Because I'm fairly safe with this comment today on a livestock forum, but unless I'm mistaken, every animal needs feeding every day. And livestock farmers generally have a greater role every day in their business. There's probably more opportunity in the arable sector, where certain types of arable production do have quieter periods when other activities could be undertaken. So more difficult in the livestock sector, in my view. You only have 24 hours in every day, don't you?
It's true. Yeah. Okay. Fine. Well, I think it's a good sort of point to wrap up on. So, in summary, from what I've heard from the videos, the different sectors, the comments, the questions, I genuinely think the livestock industry is one which has opportunity. The COVID situation has perhaps opened doors that weren't there before, and we really do need to get on with it, and as an industry pursue those opportunities. But I do think people are looking at what they eat, where it comes from, food miles, all the rest of it, the environment, so much more than before. So we do need to really grasp that and make something of it. So I'd like to thank all of those of you who've signed up and attended. I hope you found it interesting. I'd like to thank the panel for their time in answering the various questions. There's a couple of questions that haven't been answered. We'll email those directly. And then just a reminder, watch this space. These 2 agricultural seminars were the first in the spring series. There are more coming. We're going to have a land agency one soon. So keep an eye out for that. And there's talk of a commercial one as well later in the spring. So thank you, everybody. I hope you have a good evening. And I'd like to challenge everybody to do something fun tonight. So good evening and goodbye.